For a long time, I also thought that the economic situation was untenable and that there would be some form of collapse because the financial problem that showed itself in 2007, 2008 was never addressed. It's still there. In fact, it's worse because one result of that crisis, the authorities permitted even more concentration of financial institutions. So the notion that you have banks that are too big to fail, this obviously is a violation of the Sherman Antitrust Act. I thought too it was untenable, but what I didn't suspect was, because it never would have been possible in my day in the Treasury, was that the Federal Reserve would simply rig the markets. And it does. It's not just the bond market that it rigs by purchasing bonds to keep the price high and thereby interest rates low, but the Plunge protection team, which was formed the last year of the Reagan administration by the George Herbert Walker Bush elements in the government, to prevent a market crash that might deprive George Herbert Walker Bush of the Republican presidential nomination and the election. This Plunge protection team was created in order to intervene in equity markets to prevent a crash. It is now used, in my opinion, routinely to prevent any substantial market fall. What happens, in my opinion, is when the market starts to correct and there's some danger it's going to start running away downwards, the Treasury, backed by the Federal Reserve resources, purchases Standard and Poor futures. They go in and purchase what is called S&P future contracts, which drives the price of equities back up. So we have seen many times what looks like the beginning of a major market correction. Every time the Fed lets it go on a little bit, not much. For example, it'll go down, say today, 400 points, and it'll go back up tomorrow 300. And then it goes down another 400. It goes back up 300. So they let it down, they let it inch down a little at a time without a momentum starting that would take it way down, cause a crisis. So since the Federal Reserve now has a trading desk, it can trade everything, not just bonds, but stocks, that is equities, currencies, commodities. It can control the gold price. And we see that the Bank of Japan and the European Central Bank and the Bank of England cooperate with the Federal Reserve. So as long as you have that type of capability and the willingness of the government authorities to intervene like this, see, in previous days, they wouldn't have thought this was legitimate. Today, it's routine. So as long as they can rig these markets, they can prevent the type of crisis everyone suspects. What could undo it? It could be undone eventually from what is called the de-dollarization. The reason it works is that the dollar is the world reserve currency and everyone's willing to hold it. So if the Federal Reserve creates another $1 trillion to prop up the market, it doesn't devalue the dollar. But if countries move away from the use of the dollar such that the demand for the dollar as a transaction currency, as the currency for transacting international trade, if it ceases to play that role in a major way, then when the Fed creates another $1 trillion to prop up the equity market or the bond market or whatever, it could cause a flight from the dollar. The dollar could start losing value. And in that way, the Fed would lose control. So I think, and I may be wrong, that until the dollar is largely abandoned as a transaction currency in international trade, not just for oil, but for all of international trade, until the dollar is largely abandoned, the Federal Reserve can continue to rig the system. And they rig it hand in hand with Japanese, the European Central Bank, and the Bank of England. We know for a fact that the Japanese Central Bank purchases equities, that the Japanese Central Bank owns a significant percentage of the Japanese stock market. So we can see there, it's plain as day. We can see that they are supporting stock prices in Japan. The Japanese Central Bank supports equity prices. In the United States, it intervenes by purchasing Standard & Poor's futures contracts to prevent the market running away downward. So you have a situation where the markets are rigged by the central banking authorities.